Let's explore the significant tax implications for individuals considering renouncing their U.S. citizenship or terminating their long-term permanent resident status. The primary focus is on the U.S. exit tax under Section 877A of the Internal Revenue Code, which aims to ensure that all unpaid taxes are settled before an individual leaves the United States system. Who is subject to the exit tax? The exit tax applies to covered expatriates, which includes U.S. citizens who relinquish their citizenship and long-term residents who cease to be lawful permanent residents, green card holders. A long-term resident is someone who has held lawful permanent resident status for at least 8 of the previous 15 years. An individual is classified as a covered expatriate if they meet any of the following criteria. 1. Their net worth test possess a net worth of 2 million or more on the date of expatriation. Tax liability test. Have an average annual net income tax liability exceeding a specific threshold. For 2024, it was $201,000, and this is for the 5 years preceding expatriation. Number 3, and lastly, we have the tax compliance test. Fail to certify compliance with all federal obligations for the 5 years prior to expatriation by filing Form 8854. Exceptions exist for certain individuals, such as dual citizens at birth and those who expatriate before the age of 18 and a half. Calculating the exit tax. Covered expatriates are treated as if they have sold all of their worldwide assets at fair market value on the day before expatriation, known as the mark-to-market day. Gains exceeding an exclusion amount, that's $866,000 on 2024, are subject to capital gains tax, according to the asset's character and holding period. Specific rules apply to different asset types. Specified tax-deferred accounts like traditional and Roth IRAs, are considered fully distributed on the day before expatriation, with amounts taxed as ordinary income. Deferred compensation. Eligible deferred compensation. Distributions from eligible plans, 401ks, are subject to 30% withholding tax at the time of distribution. Ineligible deferred compensation, items like certain foreign pensions and unexercised stock options, are taxed at ordinary income rates on their present value as of the day before expatriation. Non-grantor trust. Distributions to covered expatriates are subject to a 30% withholding tax, and trust may need to recognize gains on distributed property exceeding its basis. Additionally, covered expatriates are subject to a 3.8% net investment income tax on certain investment income, which is just the same as before. Planning considerations. To mitigate the impact of the exit tax, individuals may consider timing of expatriation, adjusting the expatriation date to influence net worth on average tax liability, asset transfers and gifting, reducing net worth through gifts or transfers before expatriation while considering gift tax implications. Retirement account planning, exploring options for managing retirement accounts to minimize taxes. Trust and estate planning, restructuring trust and employing estate planning strategies to manage tax impacts. Treaty considerations, evaluating tax treaties that might reduce or eliminate certain tax obligations. Valuation considerations, obtaining accurate asset valuations according to factors like lack of marketability. Post-expatriation tax obligations. Even after expatriation, individuals may have ongoing U.S. tax responsibilities. Filing Form 8854 required to certify tax compliance for 5 years preceding expatriation. Tax on U.S. source income. Continued tax obligations on U.S. source income, including potential taxes on real estate sales under FIRPTA. Retirement account distributions, possible additional taxes or penalties depending on the account type and the individual's age. gift and estate taxes, potential transfers, taxes on gifts or bequests to U.S. recipients made before expatriation, ongoing report requirements. Additional obligations may apply based on individual circumstances. Failure to comply with these obligations can result in substantial penalties and potential criminal liability, including fines for filing Form 8854 timely and correctly. So, in conclusion, expatriation involves complex tax considerations, and strategic planning is crucial to manage the exit tax effectively. Engaging experienced CPAs and other advisors can help individuals navigate the intricacies of the tax laws, reduce potential liabilities, and ensure compliance with all legal requirements during and after the expatriation process.